At the moment, we're going to have James, who is the Chief Strategy Officer of WeCash. And I just have to quickly point out for those people in the room who, like me, as a Westerner, were not familiar with the brands, WeCash, WeLab, and WeChat are not related in any way whatsoever, other than that they just called We something. So WeLab and WeCash are not the same organization or part of the same organization. They just happen to be back-to-back here on this panel. So please welcome James on stage.
Hi everybody, it's a pleasure to be here to share what I do with you guys. I want to talk about how we enable smarter credit decisions with new data sets and models here at WeCash. A little bit about us before we begin. WeCash is an innovation ecosystem that transforms the global consumer experience. We have group business units around the world. We were founded in early 2014, and we now have presence, apart from China, also in Brazil and Indonesia. I run Southeast Asia as CEO of Southeast Asia, and we've entered Indonesia since 2017 May. We began doing subprime loans in China from a cash installment perspective, and also short-term loans of tenures of 7 to 30 days. We've since moved on to cover a wide range of asset classes, which also include mobile phone loans, white-labeled credit platforms similar to what WeLab does with multi-finance and retail partners, and also even housing rental loans, where we securitize the renters in China. A little bit more about what we have achieved. We have raised a total of $266 million over the past 4 years, and we've been profitable for the past 2 years and going global. We just announced a $160 million Series D led by Oryx and SEA Group, a listed company in Hong Kong, as well as investments from our co-investors from previous rounds. We have more than 130 million users around the world, the bulk of which comes from China. And we're rapidly growing in Brazil and Indonesia. So I'll talk a little bit more about what we do in the past year after launching in Indonesia, and segue into how we enable smarter credit decisions with data. Why Indonesia? It's a very large market that's just in the backyard of Singapore, and there's significant poor credit coverage by traditional mainstream FIs in Indonesia. And consumer finance has been growing dramatically, and there's a huge push for greater financial inclusion. The irony about financial inclusion here is that, on one hand, we want to cover the folks who have never been served by credit before. On another hand, you have concerns over privacy and security. And yet, on the other hand, you also have regulators who are interested in providing consumer protection, be it for crowdsourced lenders crowdsourced funding platforms that raise money from individual lenders and then lend out to individual or company, borrowers. So you have this competing triangle where there's constant jostling of interests, and I think you've seen 4 years of light touch regulation in China, where they've recently enacted a 36% interest rate cap in China. But that process has brought on almost the entire country onto the credit bureau. And I think a similar phenomenon in a different way will happen in the rest of Southeast Asia and Asia Pacific. And that's why we're excited to be in Indonesia, in Southeast Asia, to bring greater access to consumers who have historically been poorly served by traditional banks. This is a chart that I try to use to illustrate how we sit in the middle between financial institutions as well as borrowers. We don't behave as a lender. I think this is the P2P phrase is often bandied around in a very blunt way. I think we have to really think about P2P as the first version of how fintech came to about being, where you have Lending Club and all the other players in the Western world. And since then, there's been a lot of convergence of models. WeCash is the first institution-to-peer model in China, where we took institutional borrowers and married them to consumer borrowers. We do not do company loans. We only focus on consumer unsecured loans. And this is what we do in Indonesia, where we have credit products that we design either on our own or in collaboration with funding source partners, which could be banks, multi-finance or listed vehicles, or insurance companies, or just pure overseas institutional lenders. And we have an app that consumers access us through and provide us with access to their data and their device and cloud data. And from there, because we originated the customer, and we will then send the customers with approved applications onto the funding partners that we work closely with. In Indonesia, we currently only have cash loans of 10 to 30 days, as well as 3 to 6 months. We envision expanding upon this portfolio mix in the months and years to come. We also run in-house collection. So we basically originate, underwrite, co-underwrite, and service the customer and go all the way down to collection, right? A quick view on the kind of customers we tend to serve. These are, as I said before, thin file customers who are never properly served by financial institutions. I don't think this is something I want to touch on here. I don't think banks and multi-finance or traditional FIs should think of fintech as a threat, right? I did not have the time to visit some of the other panels, but I noticed there were some discussions about how traditional FIs need to defend against the threat from fintech. I don't see it that way. We're strictly institution to peer. We work closely with financial institutions to enable more efficient underwriting and portfolio selection and portfolio construction, right? And recovery of these loans. And these are the segments with which there is simply no unit economics for mainstream institutions to serve well. And by using technology, either from user acquisition, highly designed and tuned app, down to the backend for the loan management system and the collection platform, we've optimized and streamlined everything for maximum conversion, such that we can lower our cost per dollar disbursed, right? And these are mobile customers that we go after who have a significant digital footprint that is not currently being tapped on in a proper way. They tend to have salary levels that are not very high by our standards, but then again, we're not the audience that this service is really going after, where a classic family in Indonesia who has a married couple and a kid could be having a household income of 25 to 30 mil, which is about 2 to 3,000 Sing, and they would still not be able to access KTE loans from Indonesia or traditional institutions. So there's really no access for these guys, and you're talking about easily more than half of the population in Indonesia that's currently facing this situation. And so they turn to their friends, right? They borrow from friends, they borrow from relatives, they borrow from loan sharks, and the loan sharks charge much higher interest rates. Fundamentally, as a fintech player, we want to have such platforms to enable them to come onto the credit system, onto the credit bureau. We report to regulators, our bank partners report to regulators where the loan book resides on, and that's what we aim to do, right? Serve the underserved. It's difficult to really tell you how we do it. It's also not sensible for us to tell you how to do it. But in essence, we follow the regression rules and ranking philosophy for credit modeling, where we take real-time and historical data and mix it with third-party data, and we arrive at an ensembled outcome. We upgrade our models every month, right? I think banks typically upgrade their models once a year, maybe, and consider upgrading it at the 6-month mark. We do that very quickly, and all of that, we call this the lending robot that helps us optimize underwriting decisions and achieve speed and flexibility. Earlier, I alluded to the device and cloud data that we use, and these are just examples of what we tap on to help our models achieve resolution. And it really depends on every market we go into. In Indonesia, we use hundreds of features. In China, we use tens of thousands of features just because of the data liquidity. And I've spoken to some of my Indian counterparts, players in similar spaces in India. And in India, because of the presence of CIBIL, right, where you have significant credit scores, they only end up using 20 plus 30 features. Right? So every market has its own uniqueness. There's no one answer. It's also not a market which is one winner takes all, which is why there's so many of us, right, and trying to serve this market better. This is some examples of the screenshots of our Indonesia app, where there's an end-to-end process for application for providing additional data to the robot along the way during application and in repayment mode later on. We aim to provide this, trusted, reliable interface from which they feel comfortable sharing with us their data. And ultimately, and this is something I think Andrew, Simon, and us will talk more at the panel later. I see it as I think privacy is an obsolete notion. It was invented in recent modernity, and in the past history, no one used to care about privacy. People used to bathe together, sleep together on the beds. Privacy is a relatively recent modern invention. I think it's really a caveat emptor kind of transaction where we serve you, but we need more back in order to help serve you better, right? So I did vote for hey, it's going to change the world. We just have to, do it well. A little bit more about why we should care about alternative lending and alternative scoring models. I think earlier I've mentioned a lot about why these users do not have records. But more importantly, I think you're going to see fundamental shifts in how banking and regulation and standards are shifting to require banks to provision their income streams more real time, increasingly. And you also see traditional credit risk models by core banking and LOS systems simply not being able to keep up with the multitude of data sets that we're now spewing out in the world, right? Just as Andrew said, the RFID tag just spews up so much data. We're not really harnessing these data to provide a comprehensive, approach. I think that will change in the coming years as banks work closely with players like us, and we think we can bring that kind of real-time results to them and to our consumers, right? That's what we're trying to do. Here are some examples of what we use to detect the character, capacity, and condition of our borrowers. I think the whole point is to achieve better resolution of the scoring, more accurate, more real-time underwriting, as well as a granular view and less redundancy. Examples could be a lot of providers send out service messages to the users through their SMS. And by mining the SMS inbox and applying natural language processing to it, we're able to detect if a borrower has repayment intent or has expressed repayment behavior before. We can see if they have credit card debt that's been rolling. A lot of us no longer use SMSs actively. That's sending. It doesn't mean we no longer receive messages. And even then, I think there are a lot of other signals we can use, such as GPS clustering. You tell me you live here, work there, but your movement does not indicate that you reside between these two places. You must be lying. Right, so there are a lot of things we can do: spending patterns and analysis of transactional, benchmarks to tell if the person's good, worthy to lend money to at the amount and tenure that he's asked for. This is a very quick example just to show how by using a single data source and at a very early phase in our growth back in Indonesia, we were able to achieve much better risk discrimination by just sieving through and using code for automating the underwriting using SMS as one of the features, right? This is an example of the multi-tiered underwriting sequence we run. We have a lending robot that does the underwriting. We also have humans assisting and providing some kind of control sample for a fraction of our volume. I don't think we're at the era yet where we should let the robots run amok. We're here to provide conscience and ethics to these robots, and that's what we're here to do with this double model. We also have a counter-offer feature which allows us to do dynamic pricing. When you request to borrow this, we think you're good for another thing instead, we counter-offer you to start your credit journey with us. These are the things we do to increase our the customer's footprint with us, right? I think we're near the end. I want to spend a bit of time talking about what it means when you talk about non-performing loans. Technically, everybody thinks of it as just DPD 90 plus, loans that do not repay after 90 days. And when you look at it and you think about it, you have borrowers who are delinquent, who are willing and able. You just need to find them or remind them. You have borrowers who are unwilling but able. You just need to, so the first group you remind them, the second group you find them, the willing and unable you simply wait and restructure and be patient. And the last group, well, we made a mistake, right? And the whole point is we do make mistakes. Nothing's perfect in this world today, but the whole point is to go through this iterative process a lot quicker and achieve the results in a very much more fluid manner compared to how traditional underwriting is being done. I want to end off with a formula. Today we had Stephen Hawking leave us. This formula is nowhere close to the complexity of what he gave us, but I think it's a universal truth that powers our business. And I think we need to think about a point in which the alternative underwriting methods will flip. Just like how we're all waiting for Bitcoins to flip, Ethereum to flip and take over Bitcoin, I think the mainstream scoring will flip, alternative scoring will flip into mainstream. And one other thing I want to think about and leave you with is, I think there will come a point where the Minority Report omnipresent data inputs will kick in and permit us to do even more with underwriting. It's just that there's simply no compute power and no efficiency per watt to deliver the results, right? And we have a keen eye on how this can happen, all in line to bring a better experience to our consumer borrowers around the world. And with that, I'll end my presentation and have Andrew and Simon join me on stage.